So,
Great. Thank you.
So
Thank you,
take it
Taylor.
away,
I'm
Katie.
excited to be here. Can you all hear me? Yes. Okay, great. So I just want to kind of get a little bit of a background on who's here in this group. Founders, can you raise your hand? Let me see, I'm just going to kind of look through. Okay, and then what about like, this is your first time being a founder? Are there any first time founders? Okay, well, good. Okay, and then investors. I see 1, 2, 3, couple there. And then do I have service providers here too? I seen that. Okay, there's some service providers. Okay, great. I just wanted to kind of get an idea of who I'm talking to today. A little background on myself. I graduated from Brigham Young University and went to work for a startup here in downtown Salt Lake. It was a marketing startup, and of course there were only about 4 of us, and so I did everything there from manage the building to do all the marketing and PR, anything like that. So I got a wide variety in operations there, and then we moved to North Carolina, and I worked for Sara Lee and Hanes brands. They were combined at the time. I worked in Hanes Herway underwear, and then Hanes brands hosiery, and I worked in marketing for those brands there. Then I took a break for 10 years to go have babies, and I have 4 children. And then when we started Assure, I came back to work. So my co-founder has a JD MBA. He also graduated from Brigham Young University, went and got his JD in Wake Forest at Wake Forest University, and then his MBA here at the U. He then ran the Utah Fund of Funds. Is anybody familiar with the Utah Fund of Funds? Couple people, I see. Utah Fund of Funds, he ran that for 7 years. And then he left there in 2010. And he is also my husband. So that is a little bit of a unique situation. We run Assure together. And in 2010, he left the Utah Fund of Funds and decided he wanted to start something on his own. So he spent 2 years trying to start Assure. And some of you have probably been through that experience where you're out of work and you have no money and long time frame, you're trying to start something and your money's running out. Well, that was us. We really had, we went 2 years without having any revenue. We had prepared for it, but still didn't have revenue for 2 years. So that was a big event in our lives. So when Assure got started, we looked very different than we do now. We started with investor relations and doing due diligence for the SBA. And then in 2000, actually, let me step back. I want to tell you a little bit about what Assure does, because not many people really understand. So I'll try and explain it in a way that that this group can understand with the diverse group that we have. So we created the fast, and I'm going to share my screen too here. Sorry about that. Okay. Hold on 1 second, you guys. I have to get it into a view that I can see here. Is it still presenting?
It's showing us, but it's not in presentation mode.
Okay, let me move my notes over to a different screen then so I can make sure I can get it in the presentation mode here. And go back a little bit.
There it is.
All right. Okay. All right, so we created the fast, affordable, high volume SPV. And an SPV is an investment product that allows a few or a couple hundred investors to pool their funds together and invest in an asset, a company, a portfolio company or some type of asset like a real estate asset or diamonds or art. We do all sorts of different types of SPVs, investing in different types of assets. So what we have done is we decrease the cost of administration for SPVs by over 90%. And we've done that. Let me see if my thing will move here. There we go. So before Assure, there was a law firm, tax firm, administrators. You use several different types of firms, and the cost was really exorbitant. For instance, we have heard people paying upwards of $60,000 for documents. Well, Assure provides that for free. Tax firms, we do 1065 and K1s, and typically to pay, I know what my taxes cost every year to do our own, our business and our individual. And of course, it's typically over $5,000 to do something with our structure. So administrators usually charge a fee per year. Anyway, lots of times SPVs cost upwards of $100,000, and they take a pretty long amount of time, 3 months plus. What we have done is we've created all the services in-house, and we have a technology platform that helps us manage those services. We have typical SPV is around $10,000, and then we can spin up an SPV and close it within a week. So I want to walk through a little bit of our timeline on Assure here, how we got started. We got started in 2010, and then we had our first paying client. So we had that 2 years. Jeremy likes to say we were founded in 2010. I like to say we were founded in 2012 because that's when we first started getting money. Now in 2013, AngelList called. An AngelList, and let me see, how many of you are familiar with AngelList? Several of you, okay. They called us out of the blue and asked us to set up funds in bulk, meaning to create all the back office services for these funds and do so at a volume, a large size. So we were able to price that in a couple days, and then they decided to try us out. So it was 2013, and within 4 months we had done 60 SPVs, just Jeremy and I, and in 2014, early 2014, we were able to hire people on, and we did a couple hundred that first 2014. And so that was AngelList. And then we also started getting other clients as well. Once they heard that we were doing AngelList, other clients came up like Seed Invest, which was one of their early platforms, as well as Republic and Forge and Tribeca Angels. So we started doing special purpose vehicles in bulk. And in 2015, we could start seeing the traction. We didn't really know what was there when we first started in 2013, but we could start seeing the traction and realize that there was something more here than what we initially thought. And so we decided that if we were going to scale our business, we had to start working on technology. So in 2016, we hired our first technology person. And I remember when we were working first with clients, everything was Google Docs. The technology stacks were like Google Docs and Slack and just, a couple of these tools that were Trello, those initial tools that people had. So there really wasn't a lot out there to help us with what we are trying to do or to help the clients. So we started to create the tools in 2016. Now, this kind of brings me to our big event that made us think about what we needed to do next. To this point, in 2018, Jeremy and I had bootstrapped, and we had actually, because of the volume with AngelList, we were able to get quite a I guess kind of like a nest egg, basically just like we were able to get a lot of cash and we just packed it away, just kept packing it away, and trying to grow our business very lean. At some point, between 2016 and 2017, we could start seeing that our relationship with AngelList could possibly not be around forever. And so we wanted to make sure that we were protected. Our company was diversified enough to survive after AngelList decided to do whatever they decided to do with their business. So we were trying to protect our business, and they in 2018, with that technology growth, we also decided to market outside. Again, we wanted to make sure we were diversified enough to be able to get clients that are outside of AngelList. And so we started a marketing campaign. We rebranded and created this new Assure down here, the new A, and kind of rebranded our messaging and those type of things. And we knew that this could be a catapult to either AngelList, maybe using our technology or our service together, or it could be basically a breakup. And that's what it was. So in 2018, October, we launched our new branding and we launched our technology platform, and AngelList called a couple of weeks later and they said they want to take their business in-house. So let me go next one here. Okay, so at that point, they gave us basically 3 choices with their service. They could take it immediately in-house, they could take it at the end of the year, or they said they could take our whole business and all of our clients and keep them for themselves. So we decided that the wisest decision there was to have it to work together towards the end of the year. And one of the things I'm sure lots of you that are entrepreneurs have felt this is like, we have grit. We're fighters. When they had suggested that we give them all of our clients, we're just like, nope, that's not us. We're gonna fight here. So we had this big event, which is basically the title is Trust Your Gut. We didn't have I would say like there weren't a lot of tools that we had. We didn't have a lot of experience with, I know the structure of our company in a certain way. It was changing so rapidly, and there wasn't another group like us out there that we could compare to. And we knew that, our phone was ringing off the hook. So we didn't know, we knew that there was something there, and we knew that we had so much room to grow. But we didn't have, any tool to say, this is, we didn't even really understand how big the market was. So, so here we had to decide, we had to make a decision to grow slowly, and not change, and just kind of take it day by day and kind of, keep trying to save money. But we had lost 60% of our revenue with that change from AngelList. And we knew we were growing outside of AngelList, but that was a huge amount to lose. And we knew that if we wanted to get our technology, to keep building that technology, we had to do something. So, giving up was another option, but that's not in our blood. We're not like that. We're, like I said, we're fighters, we have grit. So we decided to raise and keep climbing. Now, our biggest hesitation, we had, being co-founders, husband and wife, and I guess in true entrepreneur spirit, my husband is not one that is can really work for people. And so that control factor was a huge deterrent to raising. But what overweighed that was that we knew that we have something here, and we wanted to keep putting our efforts towards that. So we decided to raise. And so the funding options that we had that we looked at were first like a bank loan. And our business is a services business. We didn't have any assets. So when we approached different banks to get a bank loan, that really wasn't an option. They couldn't give us enough. They didn't have any collateral, so they were nervous. We were a business that had just that they were unsure of what we did. They didn't understand what we did, and so the uncertainty there just made it so that they didn't want to loan to us. And actually, to this day, because of the type of business that we have, we really can't get bank loans other than a small type of loan, which doesn't even cover a 16th of our payroll now. So bank loans haven't been an option for us. Line of credit, we have tried line of credits with several different groups, and many of them didn't work, but we were able to secure one before this AngelList event, and that helped us get through some of the time that we had. But it was a small line of credit, and the line of credits that we were able to secure were their collateral. They had to have something to rely on, and that was our accounts receivable, and we like to keep our accounts receivable low. So that was also a deterrent there. Next would be private equity and VC monies, and what we found with private equity and VC is they didn't understand the story that we were trying to tell. We did focus our story on not the technology that we're building, but on special purpose vehicles and the growth in that market. And private equity didn't relate to our story as much, and so that didn't work as well either. The next option we had was a syndicate raise, and we had direct investments. So our business is we have several syndications that are in our business. We have many what we call deal guys or angel investors that raise with different angel groups or those type of things. And once we even mentioned that we were going to raise, the word got out, and we didn't have to do a normal fundraise like most people have to do, or most groups. So that was one way that we could do it. And then also along the lines, we had direct investments from different people that knew us and had worked with us. So our funding options, these ones on the left-hand side did not work as well, but the syndication raise and the direct investment did. Now, I have, for our business, what I have here is I have two tools basically for people. And I know I kind of planned this to be more towards founders. So I'm sure some of you have this structure of the fundraising deck. You have that. And then also the other tool that I have is a cap table pro forma. Those two were the biggest things that structure and that cap table pro forma that helped us in our raise. And I see that there's two chats here. Let me see if I can get this up here. Is there any questions here that I need to? So I see Taylor to everyone. Katie, what would you attribute not having to do a normal fundraise to attraction history of founders? Okay, I attribute it to our company and what we were doing. We had the network. We had a network, and we didn't have to go very far to use that network. Our clients were constantly, they would come and ask us if we were going to raise before the AngelList event, and we would say, no, we don't need to raise. We're good. And then when that happened and we started to put out the fillers, they just came to us basically and called us. So whereas we didn't have to go search it down. So did you get pushback on how long you had been around? Karen, can you explain that a little bit more? Like our stage in our company, is that what you're talking about?
Yeah, so really, so Makina was founded in 2014, and we didn't have a product until the end of 2018. And sometimes what I hear from potential investors is that, we've been around too long. Like, what the heck have we been doing, right? All this time. Like, why haven't we had the kind of traction that Abada had, where they raised 1.2 million off the bat? I mean, we've raised less with Assure. We've even raised less than 600,000. So I haven't had the advantage. So did you guys get pushback on the fact that you had been around since 2010, and why are you just raising now and blah, blah, blah? Right?
Yeah, I mean, yeah, we definitely had those questions. So the first thing was our relationship with AngelList prevented us from working with some other groups that were like them. So that actually caused an opportunity for there not to be any competitors against AngelList for quite a while. But the other thing that we would get is, I'm sorry, I lost my train of thought. Okay, we raised at a seed round, and we had our valuation low, and people would ask us why we did that, and we basically wanted to have we wanted to hit the ball out of the field. We wanted to make sure we were successful, and that we didn't want to increase our valuation to be too high, so that in the future, if we had to raise again, then we could be in a good opportunity. Again, ours was more we were really concerned about control. We did not want to give up control of our company. And so we were actually able, because I told you we had a lot of volume with AngelList, and we were able to pack away quite a bit of money with that. So we were able to invest too, and have the main, Jeremy and I and our holding company, we have the main ownership of Assure. So we were able to keep it through investing back in to Assure. So, and then we had, let's see. So yes, we did get that question, but we had a good story to tell, the AngelList story, and we were bootstrapped the whole time, didn't need anything. And then we had this catastrophic event that changed how we had to look on our company and our growth.
Okay. Yeah, I appreciate it. It's all about the story. I mean, it's got to be real.
It totally is about the story. You have to be able to tell the story. And, we have a bigger story to tell that we could have.
Did she freeze?
It looks like it.
Oh, we lost her.
Oh, we did.
Oh, there. Yeah.
You're muted.
Okay. So yeah, it is about the story, and the story we could have told was a technology story, but we chose to do the special purpose vehicle story, which worked, a lot better for the people that invested into Assure. Okay, let me pull up my presentation again here. And I think there's just a couple more slides.
One question that came, Katie, while you're doing that from Bart, he said, I didn't catch why Assure needed to raise. You lost 60% of revenue. Was it to cover people expense, so you didn't need to downsize to match lower revenue, or was it to fund a new opportunity?
Yeah, this is a good question. Thank you, Bart. We didn't need to, we hadn't done any marketing to that point at all. Everything came in and just flowed in. So that was one thing, is we needed to learn how to market, and we need to make the efforts to hire the people to do that. And then the other thing was to keep growing our technology. Those are the two reasons that we decided we needed to raise and spend the money doing those two efforts. So what we actually did is, let me share the screen here really quick. Do you guys see it? I am straight. Yeah, there you go. See. There we go.
Yeah, there you go.
Okay, so Let me go really quick here. Oh, going the wrong way. I mentioned the pro forma cap table. I have that. Okay. I wanted to show you our family, our brand family of what we have and where we're headed. So Boom Startup is now in the angel and seed stage here. And then, and that is our accelerator. And then we have Assure Markets, which is a signal. And basically it signals which companies are about to raise. And so this one is in beta right now. And so far it's able to predict 60% of the Y Combinator companies that go to Y Combinator. And then we have Assure Syndicates, and a couple of you have talked about that you know. Landon, he runs our Assure Syndicates. He works on seed stage to Series A, sometimes Series B, early stage. This is the matchmaker. They matchmake the companies and the founders. And then we have Assure Analytics that is collecting data from all of our services that we have. And Glassboard is the tool that we use to do all these services. So our clients come in to Glassboard and do special purpose vehicles. And what we've been building for the last 2 years with that money. Oh boy, here, sorry guys. This I'll just go ahead and tell you let me stop sharing because that doesn't seem to be working as well. We've been building a technology platform. It's called Glassboard Technology right now. And it is API focused and a SaaS, a PaaS, BaaS is what I used to say. I get all those words there. Solution that really helps people that want to run SPVs have that integration. So it's a private transaction platform that has all the tools that that people will need to be able to invest into private companies or in private assets. So we knew this was, we had the plan mapped out, and so we knew where we wanted to go, and so we knew we couldn't get there unless we had some kind of a funding round to help us give a bridge to tell our revenue met that our growth potential. So
Katie, one of the questions I had for you after bootstrapping for so long, what would you suggest to the founders here today on when and whether to raise funds? Like, what's the right trigger for them to be thinking about, and the investors that you work with, when is it the right time for a fundraise?
yeah, so I think this is something that each company individually has to decide what type of growth that they believe they'll have, and how they're going to be able to scale their business. With us, we really wanted to, the control factor was really, really huge for us. And we did not want to have, it was hard enough to manage a business with the two of us being co-founders and our family. We didn't want other things inserting, but this, we could see the vision here, and it was, we just decided that was more important than having all the control. So my advice, I mean, I don't know what advice I could give, because I think every business is different, and you just have to weigh the options out on the table and see what would work for where you're trying to go, what your goals are and where you're trying to go. And raising funds is a different way of managing a business. You just have more oversight and more input, and again, just less control. So, okay, let's see. I think there's some more questions over here.
So Karthik's
So,
question, yeah.
Steve Woods, I think, Katie,
Oh,
what
yeah.
deal size limits exist for sure? Do you mean for us, our raise, or for our clients? And you can speak up too. I'm not sure. if it's
Clients.
For clients. Okay, so our smallest SPV was $15,000. And our largest SPV has been a couple hundred million. So we had one client raise $450 million in 3 days. That was one that was pretty impressive. Yeah, and into a well-known startup that was going to go public soon.
What space was that in? I'm just curious. That's such a huge number.
Oh, I probably shouldn't. I can't go into that in depth, but it was very well known.
Katie, one of Karthik's questions, sounds like the trigger for you was whether you were ready to trade control for growth. Is that right?
Yes. Yes, that's right. That was the trigger. Is like, what's the options here? We want to keep growing, and my co-founder and I just what type of business we wanted. And the problem is Assure grows. We are pushed to meet the demands of the market. And so whether we wanted to slow down or not, we couldn't if we didn't keep growing, we would die. And we didn't, we would rather have a job and have, and then die. We've been through that many times before. And so that outweighed the control factor. So yes. Okay.
Katie, can I ask you a quick question?
Yes.
And would be curious to hear how this factored into when and how you decided to raise, but what's your long-term goal for Assure? Do you and Jeremy plan to exit at some point and get out of the business, or do you plan to stay involved in the business and build this into a family legacy, almost
Yeah.
I'll pause there. What are your long-term goals for the business?
Yeah, at some point we will exit. At some point, this is not going to be a family-run business forever, because it's not something that our children would even be interested in doing. And it's a hard. You have to have. It's a hard niche market. You have to have a certain expertise, and we just happen to have that combination together, Jeremy and I. But there's not a lot of people that can just come in and take over Assure and be able to run it in a way that can still keep growing. And so definitely not a family business. And at some point, yes, we will exit at some point.
Katie, I assume that it was kind of hard initially you just got the question, is this going to be a family legacy business? Because when you have a husband and wife team as co-founders, it changes the dynamics. And, my first two startups, I'm on my third startup, were with my now former husband, who was my co-fouder. So
yeah, we would like to keep our marriage together. Yes.
Good luck. No, I'm sure you'll do great. I didn't.
That's okay.
Which was much better anyway.
Yeah, so that is one of our struggles, is that it is hard on our family. We have 4 kids and 2 still at home, but it is hard on our family, and it is, like I mentioned, a fast-moving, high-growth company, and we both work together to make sure that we can balance both.
Katie, is there a difference in control when you raise through an SPV versus otherwise? Like, have you seen that be different in terms of how you manage your shareholders?
Yes, there is. So for instance, we had one of our syndicates that invested in us was Jason's syndicate. Jason Calacanis, I'm not sure, he's a client. He's also just well-known in the industry in angel investing. So his group, he had quite a few investors invest into his syndicate. And so when we send out information to his group, it's just directly to him. And then he disperses it to his group. So we don't have to interact with all his investors on his in the SPV. So one line item on the cap table holds several investors, to a couple hundred investors, and we only have to deal with the relationship between that one main lead and us. So we have a couple of those groups that did that. And I would say with private equity and probably some angel groups, they like to be more involved in your whenever you fundraise in the company. We had a family office invest, and they wanted to have more control. They wanted to have a board seat, and they wanted to have be our CRO or things like that. And we just said, no, we're going to keep this separate. We're not going to have your investor. We don't want you to be an employee at the same time. So that was one thing where there was some groups trying to do that. And we kind of just said, no, that's not, we want you invested in Assure. We want you to maintain that relationship with us. So.
Katie, for companies that do decide to raise, maybe they've been bootstrapped and they decide to raise, how is it different raising through or with Assure versus, doing the whole Silicon Valley / Utah / Texas, wherever you might be, VC raising, process? Because that's quite a process. Is it different through Assure?
Well, I think the first thing is whenever you are previous to 2019, we had Assure that just managed the back office for organizers. And organizers, what we call, are people that have the relationships with investors and the relationship with the company. So previous to that, it was just
back office service.
Yeah, back office services. And then we created our Boom Startup Accelerator, and we acquired that, and then we created Assure Syndicates. So now we are involved. We're changing from a back office service provider to somebody that's in the industry doing deals. We've done 45 syndicates in the past year and a half with Assure Syndicates. So one of our, Assure Syndicates is basically, we kind of call them one of our clients. And so they're like one of our largest clients in the top 10 now. So we've created our own deals. So going back to your question on, is it, I believe, let me make sure, I want to make sure I'm answering the right question. Is it different? Okay, can you restate your question one more time, Bart? So
yeah, I'm just wondering if you consider, like, now your whole portfolio of services and offerings, should a startup look at it as different from the kind of VC raise process, or in addition to, or
yeah,
how does it compare?
It could be both. It could be in addition to, it could be by itself. So yes, it could be both ways. I think there's just more options now. There's more options for people to get funding. One of the founders that was on here, Brenda, she has been working with Boom Startup, and so she has that option of having accelerator and getting a funding through the accelerator, but then also we have other networks, but she can still raise money through other groups as well. So it is, I think it just, there's more optionality now. You could do both.
Cool, thank you.
Yeah, thanks for the question, Katie. This is awesome. We've come to the end of the time that we've got, but this is fantastic. So if anybody else has additional questions, please reach out to Katie. And really appreciate everybody coming here. Katie, thanks so much for sharing your story and
Thank you.
Educating us. Really appreciate it, and look forward to seeing everybody. Oh, go ahead, Katie.
You know what? I actually do have, Taylor, I'll put I'll give you those two documents, the pitch deck and the pro forma, and we are willing to just let you send it to your network.
Awesome. Thank you so much. Yeah, we'll send that out. Really appreciate it. Thanks all. We'll see you next week.